Did you know that there are 3 different tax buckets that you should know and care about when it comes to your investments? Most people don't consider 3 different tax buckets that they have and the type of accounts that they should be using when it comes to taxes, not only for their short-term strategy, but also for their long-term strategy, like for retirement and later on in life. So it's important to know and understand these 3 different tax buckets and to be utilizing them correctly now with your investments so that you can utilize them correctly and most advantageously later on in retirement when you want to start taking your money. So the 3 different tax buckets that you need to be aware of are tax deferred accounts, tax-free accounts, and taxable accounts. So I'm going to break down each of them, what type of accounts they are, and if you get farther into investment planning, investment management, when you work with a professional, you know that oftentimes too, not only are there these 3 tax buckets that you want to be aware of for how you're contributing your money and where you're saving your money, but there's also strategy around how you can be investing in each of these different buckets as well, in the type of accounts, how you can, strategize with your whole portfolio across these different accounts to be most tax advantageous in these accounts as well within your investments. So that's another kind of second probably podcast to this, but so tax deferred account. This is probably what most people, this is the most commonly used retirement accounts that people think of. It's your 401k, it's your IRA, your 403b when you're making traditional contributions. So what that means in a tax deferred account is that you're making a contribution and you're getting a tax deduction right now. And that's what most people think about. Like, so when they're thinking about their taxes and tax planning, it's like, okay, well, I got to get all my deductions now. And so they, do their 401k contributions and their IRA contributions and look for that tax deduction in this year. And that's what you get in a tax deferred account. So you're paying, you're getting your deduction now, and you're basically pushing off your taxes. So that's the deferred part. You're pushing off your taxes till later. So the investments inside of a tax deferred account grow tax free year over year. So meaning the benefit that the government gives us in retirement accounts is that you don't have to pay capital gains every year. So you're not liable for any capital gains taxes as this money is growing for you for retirement. But when you get to retirement and you are going to withdraw your money from the account in the future, every dollar is subject to ordinary income tax. So not only what you put in your initial contributions, but now what has grown over that time as well. All of that is going to be taxed as your ordinary income and whatever that amount is in retirement. So you are deferring all of your taxes in these accounts until later on. You do, again, get that benefit in the year you make the contribution. You get that deduction off your taxes in that year, and then everything else is deferred until later. So most people understand this. This is your normal 401k contributions, like I said, your normal IRA contributions, and it's how traditionally most people save most of their money for retirement in these tax deferred accounts. The second type of account is a tax-free account. Tax-free account meaning that more often than not, when you make your contribution, you do not get that tax deduction. So this is like a Roth IRA. When you're making a contribution to a Roth IRA, you're using after-tax dollars, meaning you've paid your taxes. That counts as your income in this year that you're contributing it, and then it goes into the account. You make that contribution. You don't get that deduction this year. You're no longer deferring your taxes. You've paid your tax on that contribution, and now the money inside of the account is going to grow tax-free, same as the tax-deferred account. So you don't have any capital gains taxes within these accounts. So that's the same as that tax-deferred. It grows tax-free. There's no capital gain year after year, or there's no capital gains taxes even when you withdraw it. But benefit of the tax-free account, when you withdraw the money from this account in the future, all of it comes out tax-free. Meaning you've done the contribution amount. That is the amount that you did have to pay taxes on initially, right? In the year you contributed, that $6,000, let's say, that's what you contributed for 2022. That was still counting your income. You still were taxed on that amount. But as that $6,000 was invested in 2022, and 30 years from now, when you retire, you pull that out. Everything that you had for growth during that time also comes out tax-free. So these are a huge benefit that you're going to want to figure out how to take advantage of. Most commonly, people think of a Roth IRA. And that only, Roth IRAs will work until you hit the income limit on a Roth IRA, and then you have to be a little bit more creative. I have seen lately, especially, a really big benefit is I have seen a lot of employers are now offering Roth contributions in 401ks. That used to be a little bit less common, but it's been a lot more common lately. I've seen that on a lot of 401ks. Almost most 401ks I've probably looked at in the last year, I've seen them on probably 90% of them. So that's really a good thing to see, and a really great benefit, because you're not going to have income limits when it comes to Roth contributions within a 401k. So look and see if your 401k has that, and then you can do. And the other benefit of a Roth contributions within a 401k is that you have a higher contribution limit as well. It's the actual 401k contribution amount, where in a Roth IRA you can only do for 2022 it was $6,000. It's going up to $6,500 for 2023. And then if you're $15 you have $1,000 catch up. But in a Roth 401k, you can do the full 401k contribution amount, which is great. So you can get a lot more in there. If you do also have income limitations on contributing straight to a Roth, you can do a backdoor Roth contribution is another thing that is an option. And another way you can get money in that after in those tax-free accounts. And then a common one that people, don't think of, as much is a health savings account. So health savings account is the same. However, you can only get the tax-free withdrawal when you withdraw the money for health expenses. But I'm going to go ahead and put a nice bet on the fact that as you're getting older, you're more than likely going to have some health expenses when you're older. So this is another really great way to utilize. You are saving specifically for health benefits and that's where you get that tax-free benefit. But most people are going to have that when they're older, so you can utilize an HSA as a tax-free account as well. And then a taxable account means that when you make the contribution, you don't get any tax deduction. So there's no tax deduction in these type of accounts. There's also no contribution limits in taxable accounts. You can contribute however much you want to into these type of accounts. There's no income limits. This is like your individual investment account, just in your name, or it's a joint account with you and your spouse's name, or it's the name of your trust or whatever, and you're just that's kind of like your, catch-all people would put after they're saving for retirement, and that goes in a retirement account. Other things are going into this taxable account. You are going to pay capital gains in the years that there are pass-through capital gains. Like if you're in mutual funds, you're going to have some pass-through capital gains that get passed through to you, and every year you'll get a tax document with that on there. But then when you sell, you are also going to pay capital gains when you sell the investment, and that's going to be based off your cost basis. So again, this is kind of getting a little really technical, but you're going to have, it's not just your initial investment, it's your initial investment plus as you get dividends over time as well. If within that investment, you have this ongoing calculation called your cost basis, and that's going to be what you pay a capital gains on. So that is a taxable account. So that's the 3 different type of accounts that you need to be aware of and that you need to be utilizing when it comes to both your for your short-term taxes and for your long-term taxes. The reason this is very important for long-term taxes in retirement is, one, you have to understand and you'd be utilizing this right now in order to have these options when you retire. So when you get to retirement and you need to start withdrawing money, if you've planned this accordingly and you've thought through this well and invested in each of these different options, then in retirement you have choices. You have the choice to, okay, I need to take a withdrawal. Do I want to take it from my tax-free account, for my tax-deferred account, or from my taxable account? And the taxable account, again, it's important to know it is taxable for capital gains, but it's not taxable as income in retirement. So it's still a diversified tax account that you have in retirement. So that way, when you get to retirement, if you've only ever saved in your 401k, then you only ever get to take out money that is taxed as ordinary income in that year. You don't get to have choice. And so if you've utilized these correctly and properly as you're saving into retirement, then again, when you get to retirement, you have choice and you get to say, okay, maybe my monthly income I'm going to pull from my taxable account or my tax deferred account. So it's going to be taxed as my income. But if I want to pay for this vacation, I'm going to pull it from the taxable account because I can do some stuff there. Whatever it may be, you now have choice. If you don't utilize these correctly now, you don't have that choice. It also is part of your strategy now in the short term. So yes, maybe you are the person that does need to take more deductions as much as you can, and so you're going to do probably more in a 401k and regular contributions, but then you know you're going to also do a taxable account. Again, you can make sure your strategy in the short term makes sense, and then make sure it plays out your strategy in the long term makes sense as well. So again, these are important to understand. I'll probably do another podcast. I'm not going to do it all today because this is already a good chunk to digest. I don't want to get into the whole what type of investments you could be using within these buckets, so we can do that for a later podcast. But strategize around these buckets, understand these buckets, and think about how you can utilize them correctly for the best tax diversification later on in your life.